it is time to begin our awards ceremony. And as we get into this part of our program, it's my pleasure to welcome Mr. Henry Fernandez, Chairman of the Foreign Policy Association.
Thank you, Pat. It is my distinct pleasure and privilege to welcome and introduce Richard Clarida to all of you, members of the Foreign Policy Association. Richard will address the critically important subject of how the U.S. economy recovers from this terrible pandemic that we've been suffering. Richard is someone that does not need much of a lengthy introduction, but I would like to remind all of us of his outstanding achievements and excellent contributions. Throughout his career, Richard has been an outstanding public servant, a renowned academic scholar, and a successful global investor and economist. As a public servant, Richard is currently Vice Chair of the Federal Reserve Board for the last 2 years. He was Assistant Secretary for Economic Policy for the U.S. Treasury in President George W. Bush's administration. And he served on the Council of Economic Advisors under President Reagan. As an academic scholar, he was Professor of Economics and International Affairs for 30 years at Columbia University, with 4 years as chair of the Department of Economics. And as a member of the National Bureau of Economic Research, Richard served for 14 years as co-editor of its International Macroeconomics Annual. As a global investor and economist, Richard served for 12 years as Global Strategic Advisor with PIMCO, one of the largest fixed income asset management firms in the world. Richard entered his professional life well-trained in economics, having earned a PhD and a master's degree from Harvard University and a bachelor's degree from the University of Illinois. I would like to add that if you think that Richard, it's all about work and not fun, please think again. Because Richard is also known for making his own music. He released an album in 2016, and rumor has it that another one is planned to come out soon. Richard, it is my honor to present to you this medal on behalf of the Foreign Policy Association.
Well, it's my pleasure to meet virtually this evening with members and invited guests of the Foreign Policy Association. I'm truly honored to receive the Foreign Policy Association Medal. Past honorees have included Sheila Bair, Anne-Marie Slaughter, Paul Volcker, Jean-Claude Trichet, and of course my good friend and FOMC colleague John Williams. So with this award, I'm indeed in select company. Although I've been very much looking forward to receiving the award in person, that of course will not be possible tonight. But I greatly look forward to attending a future dinner to convey in person my genuine appreciation to members of the FPA for this special honor. Since mid-March, I, along with my FOMC colleagues, have been working from home. Indeed, just last week, we held our scheduled June meeting via secure teleconference. And while I certainly miss opportunities for face-to-face interaction along the corridors of the Eccles building, I am grateful to have the ability to work from home. And I want to convey my deep gratitude to all of those on the front lines of this crisis, those who are working outside the comfort of homes in grocery stores, essential services, and of course in hospitals and healthcare facilities. While the coronavirus pandemic has taken a tragic human toll measured in terms of lives lost and suffering inflicted The pandemic has also inflicted a heavy toll on the levels of activity and employment in the U.S. economy as a direct result of the necessary public health policies put in place to mitigate and control the spread of the virus. Real GDP declined at a 5% annual rate in the first quarter of the year and will almost surely continue to contract at an unprecedented pace in the second quarter. The unemployment rate, which reached a 50-year low of 3.5% in February, surged to 14.7% in April, an 80-year high. In May, of course, there was a notable rebound in employment and decline in unemployment, and these developments are welcome. Moreover, in recent weeks, some other indicators do suggest a stabilization or even a modest rebound in some segments of the economy. But activity in many parts of the country has yet to pick up, and GDP is falling deeply below its recent peak. And of course, despite the improvements seen in the May jobs report, the unemployment rate at 13.3% remains historically high. After the extreme turbulence witnessed in March, financial markets across many sectors have normalized and are again serving their essential role of intermediating flows of saving and investment among borrowers and lenders. Bank credit lines are providing liquidity to companies, and corporations with debt-rated investment grade and high yield are able to issue and in size in the corporate bond market. I believe, and most outside observers agree, that this easing of financial conditions since March is at least in part the direct consequence of economic policy responses to the crisis, including the actions the Federal Reserve took at our March 15th meeting and the subsequent announcement and sequential launch of 11 new facilities to support the flow of credit to households and companies. While this easing of financial conditions is of course welcome, to the extent that it supports the flow of credit to households and companies during this period, it may not prove to be durable, depending on the course that the coronavirus contagion takes and the duration of the recession that it causes. At a minimum, the easing of financial conditions is buying some time until the economy begins to recover. As I speak to you today, there is an extraordinary amount of uncertainty about both the depth and the duration of the economic downturn. Because the course of the economy will depend on the course of the virus and the public health policies put in place to contain it, there is an unusually wide range of scenarios for the evolution of the economy that could plausibly play out over the next several years. In my baseline view, while I do believe it will likely take some time for economic activity and the labor market to fully recover from the pandemic shock, I do project right now that the economy will resume growth starting in the third quarter of this year. In terms of inflation, my projection is for the COVID-19 contagion shock to be disinflationary, not inflationary. And the data we are seeing so far are consistent with this projection. For example, core CPI prices fell 0.4% in April, the largest monthly decrease since the beginning of this series in 1957. Although the decline in core CPI was smaller in May on a year-over-year basis, core CPI inflation is running at 1.2%, the slowest pace in 9 years. While the pandemic shock is disrupting both aggregate demand and supply, the net effects, I believe, will be for aggregate demand to decline relative to supply, both in the near term and over the medium term. If so, downward pressure on PCE inflation, which was already running somewhat below our 2% objective when the downturn began, will continue. Moreover, I judge that measures of longer-term inflation expectations were, when the downturn began, at the low end of a range that I consider consistent with our 2% inflation objective. And given the likely depth of this downturn, we are at risk of falling below that range. The Federal Reserve has a dual mandate from the Congress to pursue policies that aim to achieve and sustain maximum employment and price stability. To me, price stability requires that inflation expectations remain well anchored at our 2% objective. and I will place a high priority on advocating for policies that will be directed at achieving not only maximum employment, but also well-anchored inflation expectations consistent with our 2% objective. At the Federal Reserve, we do take our dual mandate obligations of maximum employment and price stability very seriously. And since March 3rd, we've deployed our entire toolkit to provide critical support to the economy during this challenging time. In 2 unscheduled meetings, we voted on March 3rd and 15th to cut the target range for the federal funds rate by a total of 150 basis points to its current range of 0 to 25 basis points. In our FOMC statements, we have indicated that we expect to maintain the target range at this level until we are confident the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. On March 16th, we launched a program to purchase Treasury securities and agency mortgage-backed securities in whatever amounts are needed to support smooth market functioning, thereby fostering effective transmission of policy to broader financial conditions. To date, these purchases have totaled more than $2.3 trillion, and as we indicated at our June meeting, they will continue in coming months at least at the current pace, which should sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. Since March 17th, the Board of Governors has announced the establishment of no fewer than 11 new facilities to support the flow of credit to households and businesses. These programs are authorized under emergency lending powers granted to the Fed under Section 13(3) of the Federal Reserve Act and are available only in unusual and exigent circumstances, and with the consent of the Secretary of the Treasury. These facilities are supported with money invested by the Department of the Treasury, drawing on appropriations of more than $450 billion authorized by the Congress in the CARES Act for the specific purpose of investing in Fed programs to sustain the flow of credit to households, firms, and communities during the coronavirus pandemic. With these facilities, we are providing a bridge by stepping in and supporting lending throughout the economy until the recovery takes hold. These programs are designed to offer backstop sources of funding to the private sector, and just the announcement that these backstop facilities would soon be launched appears to have bolstered confidence in capital markets, allowing many companies to finance themselves privately even before the facilities were up and running. But importantly, these are, after all, emergency facilities, and someday, hopefully soon, the emergency will pass. When that day comes and we are confident the economy is solidly on the road to recovery, we will wind down these lending facilities at such time as we determine the circumstances that we confront are no longer unusual nor exigent. The Federal Reserve has played a leading role in the global economic policy response to the coronavirus pandemic. Foreign financial institutions borrow and lend in dollars, and these dollar funding markets seized up when the pandemic emerged. In integrated financial markets such as ours, these strains in dollar funding markets outside the U.S. affect the flow of credit to U.S. households and companies. As such, during the week of March 15th, the Federal Reserve coordinated with 5 foreign central banks to enhance its standing dollar liquidity swap lines. In addition, temporary swap lines were reestablished with the 9 central banks that had temporary agreements during the global financial crisis. Moreover, to support dollar liquidity to a broad range of countries, the Federal Reserve announced a new program on March 31st, the temporary FEMA repo facility. Under this facility, FEMA account holders at the Federal Reserve Bank of New York can enter into overnight repos with the Federal Reserve, temporarily exchanging U.S. securities in their accounts for U.S. dollars. These dollars can then be provided to institutions in their respective jurisdictions. All of these facilities have had a very constructive effect in calming dollar funding markets and supporting a return to more normal conditions in global financial markets more generally. Of course, as members of the Foreign Policy Association, you are well aware that developments in the U.S. economy do not happen in isolation from the rest of the world. We live in a globally integrated economy. With the pandemic, all countries have been hit by a global common shock, not only directly by the virus and the measures to contain it, but also by the economic spillovers from those actions around the world. As in the U.S., many foreign authorities have taken swift and forceful actions in response. My colleagues and I at the Fed have worked closely with others, bilaterally and in international forums like the G7, the G20, the BIS, and the OECD, to monitor and address the effects of the pandemic. The forcefulness and synchronized timing of actions by fiscal authorities, central banks, and regulators have helped support the incomes of households and firms and have reduced market stresses that could have amplified the shock. Now, not only is the Federal Reserve using its full range of tools to support the economy through this challenging time, our policies will also help ensure that the rebound in activity when it commences will be as robust as possible. That said, it is important to note that the Fed's authority grants us lending powers, not spending powers. The Fed is not authorized to grant money to particular beneficiaries to meet the payroll expenses of small business or to underwrite the unemployment benefits of displaced workers. Programs to support such worthy goals reside squarely within the domain of fiscal policy. The Fed can only make loans to solvent entities with the expectation the loans will be repaid. Direct fiscal support for the economy is thus also essential to sustain economic activity and complement what monetary policy cannot accomplish on its own. Direct fiscal support can make a critical difference not only in helping families and businesses stay afloat in a time of need, but also in sustaining the productive capacity of the economy as we emerge from this downturn. Fortunately, the fiscal policy response in the U.S. to the pandemic shock has been both robust and timely. In 4 pieces of legislation passed in just over 2 months, the Congress voted $2.9 trillion in coronavirus relief, about 14% of GDP. Depending on the course of the virus and the course of the economy, more support from both fiscal and monetary policy may be called for. In conclusion, the coronavirus pandemic poses the most serious threat to maximum employment and potentially also to price stability that the U.S. has faced in our lifetimes. There is much that policymakers and epidemiologists simply do not know right now about the potential course that the virus and thus the economy will take. But there is one thing that I am certain about. The Federal Reserve will continue to act forcefully, proactively, and aggressively as we deploy our toolkit, including our balance sheet, forward guidance, and lending facilities to provide critical support to the economy during this challenging time, and to do all we can to make sure that the recovery from this downturn, once it commences, is as robust as possible. Thank you again very much for this award, and I look forward to joining you soon in person. Thank you.